Hey guys, Ken Boyd with the Accounting Accidentally website, where you'll find over 400 blog posts and over 400 links to my YouTube videos. So I want to talk about something that's related to my Cost Accounting for Dummies book, which is allocating overhead. We have variable overhead and fixed overhead variance. I think this is technically really challenging, so I wanted to go through some of it, not all of it here. So you've got overhead. Overhead is allocated. It can't be directly traced to a product or service. So the question is, how do we allocate it? Well, based on a cost driver. And what I've got over here to the right is, you can think of a cost object as a sponge that is absorbing costs. So it's a product or a department or a certain activity. The cost driver makes your costs bigger or smaller. So what is driving your cost? Well, if we go back to the left, typical cost drivers are machine hours, labor hours, or processing time. What I have here is the chart to figure out variable overhead variance. So we have a variance because we are allocating overhead, then we have actual, and we have differences. So the way to read this chart is actuals over on the right, on the left. The allocation is on the right, and then we have a mix in the middle. So let's go through this. So let's start with the easiest side first. Actual variable overhead incurred, which I always like to say is the check that you wrote. So you had actual hours, 4,000. You had an actual rate, $100. Could be per hour, per unit. You multiply that together, you get the 400,000. On this side, the right, we have a flexible budget, variable overhead for standard hours. So a flexible budget is applying standards to actual production, because what's going on here in the middle is applying a standard in blue to actual production, which is hours in black. So to go into a little more detail, down here, and I'm not going to go through the whole thing, we figure out what we call a predetermined overhead rate. We figure out hours per unit, some assumptions about the units we're going to produce, and that's how we come up with the standard, which is up here. So we think in our production, we are going to work 3,500 hours, and we're going to multiply that by the actual units. We come up with a standard cost per unit that's figured out below. So if I multiply 3,500 times 110, I come up with my flexible overhead for standard hours. We think we're going to spend, we plan, we allocate 385,000. The check that we write is 400,000. Now in the middle, you'll see that we have a mix. It includes actual hours. It also includes the standard overhead rate. And you'll see that we multiply 4,000, the same actual hours. We use the standard overhead rate in blue, which is 110, and I multiply down and I get 440,000. Now, a variable overhead variance can be split into two different categories: spending variance and efficiency variance. Now, before we get too deep in the weeds, here's the way to think about it. A spending variance means that per hour, in this case, our per hour rate actually was higher or lower than we thought. So when you think spending, think of a rate. Efficiency means you used more or less than you thought. Let me do that again. Spending, you spent on an hourly rate, in this case, more or less than you thought. Efficiency, you used more or less than you thought. So because actual is less than this number in the middle, we have a favorable variance because what we actually spent, 400,000, was less than the 440,000 in the middle. We have an unfavorable, so we have a favorable, in brackets, spending variance. We have an unfavorable efficiency variance because of the difference between the figure in the middle and what our standard was. So if you combine them, that's how you come up with your total variance, which in this case would be 15,000 unfavorable, 55,000 less 40,000. This is a very difficult topic, and I have found that the only way to do this is to set up a chart like this with your actual data here, your standard here. You figure out the standard below it in this area. and down here. And then when you add up the three columns, your variances are either a spending variance or an efficiency variance. Very difficult, takes a lot of practice to get through this. And that's a discussion on variable overhead variance. I'm going to do a separate video on fixed overhead, which is the next tab. Remember that when you go to the center of the website page or over here in free download, you're going to come up with 18 spreadsheets that explain intermediate accounting, which is a free download. And what you'll receive is these 18 spreadsheets that I have used in my YouTube videos, and you'll get links to the YouTube video for each spreadsheet. Here's an example of what you'll get. So if you want the spreadsheets, just email me here. I'm going to send you a link to Hightail, which is my cloud backup, and you'll be able to download all of them at once or one at a time. Thanks for watching, and we'll see you next time.